6:17 as we get things underway today on this pre-hump day edition of the show. I'm always optimistic. Always looking a day ahead.
Always counting forward.
Exactly. So this morning markets are looking to open lower again. Now, yesterday it was interesting because the market sold off very hard at the open and then rallied back. A very strong rally back towards the end of the day yesterday. Dow recovering about 400 points from the early morning open, which was, positive because the markets are really anticipating that, these trade talks are going to continue to go forward and we're going to get this resolution done. And really kind of the hope here is that this is just part of Trump's kind of art of the deal thing, right? Threaten to have these tariffs put on to kind of get the giddy up, as they say in Texas, into China, to get them to move on and get these trade deals done. But as I was saying a second ago, the biggest problem for China is that some of the requirements that are being put forth by the U.S. in terms of getting their deal done requires a big leap by China in terms of reforming laws, putting themselves in a position to where it may crimp their growth plans, their economic growth strategies over the next few years. So, you have to also look at this from China's view, which is they're dealing with a president currently who will be out of office between next year and 4 years from now, depending on whether he wins or not. So the issue with that is that China has got a 50-year economic growth plan. So acquiescing to a deal that's not necessarily in their best interest for a short-term benefit, because look, once Trump's out of office, it's unlikely that any type of deal that Trump has put together is going to be enforced by the next administration, particularly given the angst and animosity in this current environment that we live in. China knows this. So for them to agree to a deal that binds them into something that will impact their long-term economic growth plans is going to be very difficult for them to achieve. So if they can agree to a deal and to terms that are not overly burdensome or overly extraordinary in terms of their plans, right? Then that could certainly happen. And this is something we've talked about before. We've actually seen this occur as of late, is that, this trade war that was started at the beginning of 2018, we said was unwinnable in its original form. And since that time, we've seen the U.S. back off a lot of the initial demands that it had wanted, has softened its stance on a lot of different positions. This is something now that both economies want just to be rid of. It's impacted China's economy, and it's definitely impacted ours. We've got rising bankruptcies in America farmland. We've got corporate earnings that have been tremendously weak, as well as the fact that forward guidance has had a very, very big decline for companies over the course of the last 2 quarters because primarily of the impact from tariffs. So both sides really want this trade war finished so that we can move forward and things can get back on track. But again, from China's point of view, they're dealing with a short-term liability versus a long-term economic growth plan that they have. So this is going to be very interesting to watch here over the next few days, and particularly as we head towards Friday. So Friday night, midnight, 12:01 a.m. is when this additional impact of additional tariffs will go into play. We'll increase the current tariffs from 10 to 25%, potentially add more tariffs down the road. This is, one thing to remember is that tariffs are not directly burdensome on the country, right? Who it impacts is the actual consumers on both sides of the water. So we buy a lot of stuff every year, about $50 billion worth of goods every quarter from China. So when those goods come in, our TVs and smartphones and clothes and all this other stuff that we order that's manufactured in China and brought here, that's going to go up in price by the rate of the tariff. So that tariff is going to get passed on to consumers, with consumers already kind of strapped in terms of living paycheck to paycheck. We've talked about those statistics before. increased costs on goods that we buy are impactful. Take a look at what's happening with imports as of late. Imports have since this trade war, imports into the U.S. have slowed fairly markedly. That's consumption, right? 70% of the economy is consumption. So you raise the price on goods and services because of tariffs, and that's going to impact the ability of consumers to consume. They're going to have to make some choices. When you don't have the money for something, you ultimately have to make a decision to make an alternative move. Either you buy something, another cheaper good, or you just have to forego that purchase for a while until you can't afford it. And this is why we're seeing consumer debt hit record levels. As we talked about last week, about $3,000 or so a year is the deficit between the standard of living for most Americans and what they actually have coming in the door in terms of income. So that's got to be made up with debt. Now, this all works as long as we can consume to a certain level. The problem becomes, and economically speaking, this becomes a problem, when the prices get so far that consumers have to actually just pull back and they can no longer meet those requirements that they need to meet their standard of living. This is where you begin to see the impact into the economy. And we've seen some early evidence of that. We had some weak retail sales earlier this year. We'll see what this kind of looks like going into the summer. There's a lot of variabilities to these numbers. And one thing that happens when we report numbers is that we report the number, right? So unemployment is, 3.8%. Okay, great. But what was it last month? What was it the month before that? Retail sales were up 0.9% or whatever it was, this month. But what was it over the last several months? The trend of the data is always much more important because it tells us the direction in which the economy is heading. And when we look at those trends of economic data, whether it's leading economic indicators or a composite economic gauge of any type, what we clearly see is a weakening trend in the economic data. And this all started when we started these tariffs and this trade war. So not surprisingly, you increase costs, you're going to wind up impacting the economy. So both countries want to get this trade deal done. They want it off the table. This was why there was a lot of discussion of this in December, in particular, a big kind of ramp up in the media in terms of virtually every day on CNBC or Fox, was Larry Kudlow saying, we're going to get a trade deal done. We're right there. It's just going to finish this up real quick, have this deal done by the end of the month. Of course, this has kind of been dragging on and on now, month after month. And now we're back into this issue. So, both countries want this done. The difference, as I was saying a second ago, is that where we were the last time we started this and where we are today are two very different places. When we had started the trade war last time with China, we had just passed tax reform. So there was a lot of optimism from tax reform. There was a big boost to earnings. There was a lot of potential there, potential support for the economy. The Fed was still hiking interest rates at the time. But again, there was a lot of support here from tax cuts and tax reforms for corporations. Now, fast forward a year later to where we are now, a lot of those tax cut benefits have been absorbed by companies. We're now comparing earnings on a year-over-year basis. Earnings are slowing. There's clear evidence, and this is not just somebody's opinion. There's clear evidence that earnings are slowing. And yes, companies are beating estimates this quarter, and we're seeing a lot of companies, report earnings above estimates. But remember, those estimates were lowered by almost 11%, so they could beat those estimates. So again, we've always got to look at where we came from and where we are when we talk about beating estimates. So earnings are clearly weaker. Revenue growth is slowing. And now we're starting to trade war again. So from a structural standpoint of where we are today versus where we were at the last time we started a trade war are two very different places. So the amount of leeway that President Trump has in terms of playing hardline and hardball with China is a lot less than it was then. Now, thankfully, the rally that we've had from the December 24th lows till now has given him a bit more working room. Again, as I was saying a minute ago in the last segment, if we were still, kind of hanging around the December 24th lows, there would be no operating room whatsoever for Trump to pay hardline with China. Fortunately, the rally has now put him back into a position where he's got that. So we've had this big return. We had this big ramp up in the rally. Confidence has returned because of the rally in the markets. Approval ratings for President Trump are up because of the rally in the markets and better economic data. Had a rebound from the fourth quarter. So all those are giving him a bit of working room here with China, which is a good thing. Now, it's going to be important, though, is that he gets a deal done fairly soon. The markets aren't going to hang around for a long time waiting for a deal to be done. The conversation has been since December that a deal was about to be done. The markets have priced in a deal with China. So whatever deal is done is going to be quickly basically absorbed by the markets. And actually, this is, it would not be surprising at all to see a trade deal done and actually the market sell off, because kind of a buy the rumor, sell the news type event. We've priced in a lot of any type of economic benefit that could be derived from a trade deal as well as from the market itself. The recent advance has driven the market up. It's been driven not by earnings growth, because that hasn't happened. It's been mostly a valuation expansion issue. We're back to very, very high levels of valuation, have completely reversed that kind of buffer that we got last December. So pay attention here to your money in particular, because what happens over the next really 2 weeks as we head into the month of June is going to be very critical. But the entire report's on the website as you get by there, as well as Technically Speaking, Trade War and Go Away. That's the article for today. It's on the website now, realinvestmentadvice.com. We'll be right back.
Talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.